I shall start the recording now. There we go. Anything I say or do can be held against me in a court of law. All right. Welcome, PitView traders. Today, there was a bit of confusion, so let me just give you a bit of background. Last Monday, which was probably a horrible Monday to come into class because it was Labor Day here in the U.S., and there's quite a few of you that are here in the United States. It was a national holiday. So there was a lot of students that had to play catch up when it came to the recordings from our Gartley Pattern Part 1. And as I told the students last week, this Monday we were going to continue on with the subject going into Gartley Pattern Part 2. The confusion this morning was in the subject matter, it still said PitView depth. I thought I had edited the subject matter for today because I moved PitView depth as far as trading that to next Monday. So you should be able to go in and re-sign up for that. But today we're going to be continuing on with Gartley Pattern Part 2. So I apologize. I don't see any new people in here from last Monday. Most of you are already aware that we were going to cover Gartley Pattern Part 2 today. So if you're in here expecting PitView depth, we will be covering that next Monday because I want to make sure that you got this. I've been teaching the markets for 17 years now, so I always feel it's important that people get a subject. So this is a very powerful pattern in my opinion that I think is very strong for trading the markets and getting good risk reward. So it may not go a full hour today, but I do want to make sure and cover some things, review some things that we covered last Monday, and get into a little bit more detail on how to use PitView to get into some better entries using the Gartley pattern, since you're all PitView subscribers. So with that being said, I'm going to go ahead and resume into the Gartley pattern, going into Part 2, do some review here, and we'll rock and roll from there. So welcome. All right, so reviewing a bit of what we talked about last week as far as what a Gartley is, defining what a Gartley is, if you will. One thing to remember when it comes to technical analysis, as we discussed last Monday, is the fact that a lot of things in the market, a lot of technical patterns are very subjective. For example, the Gartley pattern is a very good example of something that's very subjective in the market because of the fact that Gartley, back when he wrote the book, what was it, almost 100 years ago, I'm sure that he didn't use any type of Fibonacci retracements in his pattern. It was essentially what we call an impulse move, which we consider to be X. That's a strong trending movement, a directional movement, followed by a correction, which we would call an ABC correction. Essentially what it boils down to is a series of lower, we got an impulse move, which is a strong trending move, followed by lower highs and lower lows, forming an A correction. Then the A breaks on. Let me, I know you all, how much you all like my my pin when I bring that up here, because I tend to draw everywhere on the charts. So we got our strong impulse move, strong series of higher highs and higher lows. In the case of a bullish Gartley, a bearish Gartley would be a strong trending move of lower highs and lower lows, followed by that trending move breaking apart into lower highs and lower lows. The initial set, which would be called an A correction. That A correction breaks apart into a small set of higher highs and higher lows, which would be considered the B. And then that B breaks apart into another set of continuing lower highs and lower lows called a C. And what Gartley really defined, the way that we define it is Gartley having presented itself before it hits what we call the 78.6% retracement. The subjective part of the 78.6% retracement is that there are some traders that will use an ABC, define a Gartley as it's hitting a 61.8, even a 38.2 sometimes as being a Gartley. And the weird thing about trading is that they're all right, because essentially what Gartley wanted, an ABC correction, is he defined it as A and C being equal. Essentially an impulse move with its X with an ABC correction, whereas A and C are equal. That's what a true Gartley pattern is. This right down in here, the Fibonacci, Gartleys have grown into being what we call a Fibonacci pattern for more harmonic traders nowadays. That's what really people define the Gartley pattern as being, is a Fibonacci pattern? Well, in terms of Gartley himself, Gartley just defined it as a pattern of higher highs and higher lows that break apart into lower highs and lower lows, which breaks apart into a small set of higher highs and higher lows, and then into what we call a C, lower highs and lower lows. Whereas this initial retracement between the A and the C are equal to one another. That's really what Gartley defined it as. He didn't really have this as part of it. This was added later by people like Larry Pesavento, who defined it in terms of how it retraces in the midst of a Fibonacci retracement. Now, the entry for us, as far as looking for our entries, generally is defined at the 78.6 level is the way I like to look for retracements on a Gartley. So a lot of the retracements themselves, the Fibonacci's, is personal preference. I personally like the 78.6% by itself, no matter what the pattern is that comes down to it, because if you look historically in the markets, the 78.6% retracement level tends to be a powerful support and resistance level in the markets. Now, the good part about these being what we call Fibonacci retracement patterns, or Fibonacci patterns, if you will, is the fact that we can use Fibonacci because, again, what we look for is that impulse move, A, B, C correction, whereas A and C are equal. When you add what are called harmonic rules to the pattern, this is what makes them a little bit easier to spot on the chart. The harmonic rules is essentially what can define A and C being equal. As retracements are coming down, something that can give traders a visual, a set of rules, if you will, that'll tell them, here's how you enter into a Gartley. Here's a what we call a harmonic Gartley, a rule-based Gartley, and here is where, here's something you can easily spot on a chart. So the Gartley harmonics, the rules, if you will, for spotting a Gartley is you need that initial retracement of A. Whenever I say A, B, that would be, you would need the end of A, the start of B, the retracement, to be at approximately 61.8% of X, which is your initial impulse move. And then when A breaks apart into B, you need the end of B, the start of C, to have ended between 38.2 and 88.6 of the A correction. And then what you're looking for is you're looking for the end of C, the start of D, to retrace to approximately 78.6 for your entry trigger. So you want it to form as perfect that A, B, C correction as you possibly can. Now, this is a lot of review from last Monday, so let me just kind of show you what we covered last Monday as far as spotting these Gartleys on the chart, because this is the email that I get from a lot of people is, I don't understand that. What exactly are you talking about here? Well, let's do just a quick review of it, because this is an easier way to spot Gartleys. So here, this is what we call a bearish Gartley. It's an impulse move with an ABC correction, whereas we're looking to sell. So on this dollar-yen on the 1-hour chart, you see that we have the set of our impulse move, our strong set of lower highs and lower lows, where we connect the high and the low with our Fibonacci levels, and that'll show us as this retraces back up against that initial impulse move of what we're looking for as far as an actual pattern. So the first rule that we need is that now that this is breaking up into a series of higher highs and higher lows, that would be called an A correction. And once we see that A correction start to end, we need that A retracement to have ended at approximately, and this is the subjectivity, approximately 61.8% of X, which you see over here, that's a 61.8% retracement. And then as we see this start to break apart, we see the A start to break apart into lower highs and lower lows. We need this B right in here to have retraced between 38.2 and 88.6% of A. If you were to connect the low to the high of A, you would see on this chart, this is what we call a perfectly harmonic Gartley pattern, that the B retraces to 61.8% of A. So that is between our levels to where we can call this a harmonic Gartley pattern, because you see the end of B right in here, the start of C, has ended between the 38.2 and 88.6% of A. And then from there we can get a C retracement. We start to see the market start to make a significant amount of higher highs and higher lows. And that's when we see that we are in fact getting a C correction. And if that C comes up, with obviously not making some type of precipitous move to the downside from here, but a strong set of higher highs and higher lows that we would signify as C, once C touches the 78.6% of X, which is the entire move itself. Remember, we're looking at this in its entirety. That would be what we call our entry trigger. So that would be, this would be a sell signal on the chart, if you will. And as I stated last week, when you see these types of patterns occur in the market, one thing about Gartley pattern is, yes, you are in fact you kind of going against the most immediate trend. When you're looking to go short into an immediate uptrend or going long into an immediate downtrend, what I mean by that is, as the market's coming up, you are looking to sell and be a seller, which obviously it takes a little bit of intestinal fortitude, because honestly it can be quite uncomfortable entering into these Gartley patterns. Now we'll go through some examples of that, but here's where some confusion was. Here's another source of confusion for some folks, and we'll go in live and look at some charts here in just a second as far as, you know, what constitutes a Gartley pattern if it's not perfectly harmonic. You know, those rules that I just showed you as far as where A has to retrace to, where B has to retrace to, and where C has to go in order to get an entry, those are called harmonic rules for a Gartley, and generally created by a guy named Larry Pesavento, among others in the industry. But remember, Gartley himself said, you know, in his book, you know, the namesake of where the pattern comes from means that, you know, what do we have to have in order for it to be a Gartley pattern? Well, you need an impulse move with an ABC correction, whereas A and C are equal. Now, defining the harmonics rules that I just showed you, those are things that we use in order to define equal. Because obviously when you're measuring out the A and the C corrections in the midst of a correction of an impulse move, they're not going to be equal. You know, it's going to be very weird to have a Gartley pattern where A and C are perfectly equal as far as the number of pips involved in those movements. So another way to define equal, besides eyeballing it, I kind of put that in for a joke, but you'd be surprised how many Gartley traders just eyeball it and say, oh, looks equal to me, let's go with it, is you can actually get a little bit more. If you see that things are retracing and it looks like an ABC correction, but it doesn't perfectly match up with the harmonics of the Gartley, what you can do is you can measure the length of A and what we call the projection of C, because generally speaking, a lot of times with these Gartleys, and I'll show you an example of one today, a lot of times with these Gartleys, they're not, you know, you're watching them set up before they've actually formed the pattern itself. You're starting to see Gartleys as they form. You see a large move up followed by an A, a B, and then you start to see kind of a C coming down, and that's really when you start looking for entries into a Gartley pattern. So what you can do is that if you see that the harmonics aren't lining up perfectly, let's say the A does not retrace perfectly down to 61.8, it stops a little short, but you see that there's an A, B, and a possible C coming down, and you want to see if it might be a Gartley. What you can do is you can measure the A correction, the initial A correction, and then once you see that there's an end to B, a possible end to B, you can measure the C correction, or what we call the C projection, if you will. Actually, I should probably change that to C projection down to the 78.6 level. And what you would do is, whichever is longer, whether it be the C projection or the A correction, you would take 75% of that number, and whatever the smaller, whether it be A or C number is, as long as it's within 75% of one another, if it's within that range, you can consider them to be equal. There's a lot of Gartley traders that, you know, taking the Fibonacci harmonics out of the equation, would just look for an A, B, C, and as long as they're within the A and the C waves, if you will, the A and the C corrections, as long as they're within 75% of one another, they would consider them to be equal. Some people might use larger percentages like 80%, 85%, 90%. The 75% I've seen has been kind of the most common way when traders trade Gartley, such as this one, to where they would consider it to be equal. So in this bearish Gartley example, whenever, I know this is a perfectly harmonic Gartley pattern, so we know quite well that it's probably going to be equal. But when you're measuring these things out, you would measure this A projection, which in this case is 81.4 pips. And when you're looking at this C as it's coming up, once you start to see that there's a C coming up and you start to say, okay, well, if this comes up and hits the 78.6 level, I would consider the A and the C to be equal to one another. However, let's assume that it's not hitting perfectly off the Fibonacci retracements, but it looks like a nice little ABC. I'll show you an example of one from last week. Well, can I still trade this as a Gartley? Well, in this case, we know that the A is 81.4 pips. The projection of C, if you measure it just from the end of B, even if it hasn't hit yet, even if the C is like sitting right in here, if the projection of C from this point, the end of B, to the 78.6 level itself, if you measured that amount, okay, you see that the C is, the projection of C would be 75.5 pips. And I can show you a great example, which is also on the PowerPoints, but we'll go live and look at an example of this, and you can kind of see what this would look like. So what we would do is say, okay, well, are these close enough? This A correction and this C projection, are these close enough as far as the amount of pips to one another for me to consider this to be a Gartley? Well, we know the A is 81.4, the C projection is 75.5 pips. So all I do is I take whatever number is higher between these two. I would take 75% of that number, and that comes to 61.1 pips. So as long as the smaller number, which in this case is the C, is 61.1 pips or higher, I would consider the C projection to fall within what we would call equal when it comes to that range. Now let me show you an example of this. Here, hold on one second. Let me go live for a second. And pull up my charts here. There we go. This is one that a student, one of my students had sent to me last week from my Essentials class, and they were asking me, Steve, could I consider this to be a Gartley pattern? Because what we have is we have an impulse move. We have a strong uptrending move that's retracing upon itself. Now, the thing about Gartleys is, remember, they're a Fibonacci pattern, meaning you can trade these as most of you are used to hearing patterns being called like a reversal pattern, like a head and shoulders top, head and shoulders bottom, or a continuation pattern where you look for either reversals or continuations of a trend when they break a pattern. Fibonacci patterns can be traded both. They can be traded as reversals or continuations of an overall trend. So this is one that a student sent to me because we have an impulse move right in here where if we connect the low to the high of this move, harmonically, from the low to the high of this move, when we get this little A coming down, you see it, it breaks apart into a series of lower highs and lower lows, which we would consider to be an A. However, the A does not retrace to the 61.8% level. And some people might say, well, it's not even approximately 61.8% of this X, which is the impulse move. This would be X right in here, this long trend right in here. So I get this question a lot to where it didn't come down, Steve, to even, what I would call, approximately 61.8. It didn't even come close to hitting it. And it came up and formed a B, corrected upon itself into a B. But now it looks like, Steve, it's coming down and forming a C. Now in this case, the question becomes, well, here, I'll just bring it up on my little notepad here. R, A, and C equal to each other. Well, let me get the chart done to where, to where this student had sent it in to me, because he saw this occurring right here at the bottom part of this trend. To where I've connected the low to the high, we saw an A coming down, an A correction, then we saw a B, and then we saw that it was coming down and starting to form what looked like a C at this point. So at that point, what I would do, and you can do this with the crosshairs on MetaTrader, is say, okay, well, let's measure the length of A. From this high to this low right in here, let's measure the length of A. In this case, the length of A is 72.9 pips. Now you see that middle number, when I do the crosshairs over here on the MetaTrader, these crosshairs, if I click the top and I drag it to the bottom, so I measure the entire length of A, I just drag this crosshair down, you see that middle number right in there where it says 722? On MetaTrader, that means 72.2 pips. So that's what we would do, is we would say, okay, well, the length of A is 72.2 pips. And then what we would do is say, okay, projection of C at this point. If I see that it's starting to come down in here, if I see that it's starting to come down, and if it comes down and hits the 78.6, you would consider it to be pretty damn close to being a Gartley, even though it didn't hit perfectly off that 61.8 level. What I would do is I would take my crosshairs and I would go from what looks like the end of B right up in here, and I would take my crosshairs and I would measure it down to the actual 78.6% level. Okay? And that would, you see the middle number there? When I measure it from the top of A down to the 78.6 level, it says, okay, the projection of C, if it does come down and hit the 78.6, the projection of C is 70.7 pips. So in this case, I would say, okay, we know that they're within, 75%. Here, I'll bring up my calculator. I would just take whatever the higher number is, whether it's the A or the C, and say, okay, 72.2. So I need, the C has to be 54.1 pips or higher. Is it? Yes, of course. We can see already that these are very close to one another as far as the length. So the question becomes, even though this didn't come down and hit off the perfect harmonics, if you will, down to the 61.8, is this a Gartley pattern? And the answer for me is yes. Yes, it is. So at this point, you would look, if this does come down, without the C breaking apart too much and coming down, but if this C continues down into this trend, what you would look at is, once it starts coming down, especially when it breaks the low of A, is generally when you would start looking for entries as it gets closer to the 78.6 level. Because once this comes down and hits the 78.6 level, this is your trigger. This was it's trading the 78.6. This would be my trigger. So the buy entry on this, and I'll show you a different way to buy on this. The buy entry on this would be the 78.6 level itself, which you can see 78.6 right here is 1.08377, which is the 78.6 level. And if you want to be exact, since these charts are driven off the bid price and we're buying at the ask, you can actually account for spread on these too. Like if the spread on dollar Canadian is, let's say 2 point something pips, so you can account for spread if you wish. And oftentimes we'll put in these entries before it actually hits the 78.6 level. so that if it comes down and touches the 78.6 level at any time, this is on a 1 hour chart, you're going to be in on this trade. And this is, yeah, this is on a 1 hour chart, by the way. So in case you're wondering, you know, that's a 1 hour chart. I'm a big swing trader off of 1 hour charts. It's probably the time frame that I look at the most for Gartley patterns. 1 and 4 hour charts are probably my two favorites, but 1 hour is certainly the charting time frame that I look at most often to look for these types of patterns. So you would go ahead and you would put it in as a buy entry. Your stop on this is why we like Gartley patterns, is because your stop is going to be placed. You're wrong on a Gartley if it comes down and breaks the 100% retracement. You know, this would, if it's just hovering between the 78.6 and the 100% level, it's still giving you opportunities to get in. And I'll show you how I used PitView on this. That actually gave me a little bit better entry. It allowed me to buy at a lower price. But where you're wrong on a Gartley is if it comes down and breaks the 100%. That's what invalidates a Gartley pattern, and that's where you're wrong. So your stop on this would be 1 pip below, at least 1 pip below the 100% retracement. So let's see, that low price right in there is 1.08. So that would be 1.08087. So your risk on this trade, well, our risk on this trade is 32 pips. And then the other thing that comes along with a lot of, you know, this is just a regular buy entry. What me and my students generally do is we'll put in 2 limits on this, limit 1, limit 2, where limit 1 will look for a 1-to-1 risk-reward ratio. We'll split our trade up, move stop on remaining lot to break even. And then what we tend to do in my classes is we look for limit 2 to be the 78.6% retracement of the Gartley itself. So what we'll often do is, and here I'll zoom in on this chart a little bit more, what we'll often do is once we get a Gartley that's formed on the chart, I'll go ahead and connect the high to the low of the actual of the entire movement itself. And what we look for is we look for the second limit when people are confused as far as how much profit to look for. If it retraces to the 78.6% of the entire pattern, the entire downward movement, you see I connect the high to the low and it gives me another 78.6 level, which is 1.09159. And that would be what we call a retracement of the retracement. So that gives you a little bit better risk-reward ratio. So the first one, you're just looking for 32 pips from your entry. The second one, you're looking for a total of about 75 pips. So you're getting very close to a 1-to-2 risk-reward ratio, which is always what we like to do. Once our first profit point gets reached, which in this case on the Gartley, the first profit point gets reached almost immediately. Comes down, it hits, comes right back up. Would have been right up in here. So it came very close. We moved our stop to break even. It came very close to coming down and stopping us out based on the I believe this is non-farm payrolls last week. Yes, it was. And then continued right back up. And we're still sitting with our stop at break even, waiting for it to hit the 78.6% retracement. So we've already got 32 pips in the trade, waiting for it to kind of come up and hit that second profit point. We actually got a little bit better as far as our entry goes by using PitView, and I'll show you what that looks like here in just a second with using PitView for your entry. The main thing I wanted to show you here is that this was not a harmonic Gartley pattern, if you will. This was not something to where this was perfectly harmonic. It didn't retrace to perfectly 61.8, but you can see when you project things out, you see that A and the C are equal, and when you look at it as a whole, especially when you connect them with the lines, it's like, well, this may not retrace perfectly to the Fibonacci levels, but if you just look at the black lines on here, this looks like a perfect Gartley pattern, even though it didn't fit into those harmonic rules, if you will. Pretty interesting stuff. Well, at least if you're a geek like me, it's very interesting. Now, let me go back to the PowerPoint real quick, because there's some other things that I want to cover here as far as the entry and exits go. And, you know, before I found PitView, I generally would trade Gartleys very aggressively. What I mean by this is, when I saw a Gartley pattern was forming in the market, I would already have an order, in this case on a bearish Gartley, to sell at the 78.6 level with my stop right above the 100%. You know, that's generally what I would do. There's all different ways to trade, but on Gartley patterns, it's probably the one pattern that I'll trade very aggressively, meaning before it even hits the 78.6, if I know I have a Gartley, I'll go ahead and have a sell order already sitting there at the 78.6 level with my stop above the 100% retracement. Some traders might look for what we call a touch and close, which means that they'll wait for a candle to touch the 78.6 and then wait for a candle to bounce. That would be another confirmation. For those of you that followed along with like the lonely bar method, if you were using like a lonely bar, that would be a lonely bar entry. So there's all kinds of different ways to look at entries into a Gartley. Essentially, as long as the price is hovering somewhere around the 78.6, even if it's between the 78.6 and the 100% retracement level, which it is right in here, as long as you know you have a Gartley, sometimes you can spot these things a little bit later on, but it's still hovering within 78.6 and 100%, and it can give you a very good entry, or give you, another chance to get in, if you will. The question that's going to come up from PitView students, and this is something we barely got into last week, was, well, how do I use PitView for this? Can PitView be used as a better entry method for the Gartley? And the answer is with a resounding yes. If you've been in the intermediate, or if you've been in any of my classes before, PitView is what I would call the ultimate trade confirmation tool, and it can also be used as the ultimate entry tool as far as looking for your entries go. There's several different subjective ways to use PitView as an entry method for Gartley, one of which is as it's getting close to the 78.6 level, because sometimes these things won't even hit the 78.6 level. They'll come really close, because a lot of traders will have what's called an entry zone when it comes to trading these. So if you measure the length of the Gartley itself, before it even hits the 78.6 level, if you measure from the 0 to 78.6% level, if you see that you have a potential Gartley forming, what we would say is once price, so that you don't miss a large movement, once price gets within 10% of the Gartley projection, look for an entry using PairView. Now this is where you're probably going to say, what? I don't understand. Well, I'll show you what this looks like, because this is what we used on the dollar Canadian trade. The PairView and balance totals that we would look for when we're trading Gartley, as you get longer in time frames, you look for smaller imbalances, because as you put more data into PitView, what's considered to be a large imbalance gets smaller. Now, I don't know if any of you have covered this with me yet or not, but like on the minute charts, you can look for Gartley patterns in any time frame. That's why it's considered to be more of a swing trading method. 1, 5, and 15-minute charts, a plus 20, which would be a green 20, or a minus 20 in the imbalance totals for the pair that you're trading, would be considered very large imbalances that could give you solid entries and tell you exactly, not exactly because it's not 100%, but it's very high probability when reversals might occur in the market, when you actually are getting large shifts in supply and demand. On the 1 and 4 hour charts, as far as looking at Gartley patterns, for your actual entry techniques, you would, for a bullish Gartley, and again, for the 1 and 15, 5 and 15, for a bullish Gartley, you would look for a plus 20, once a plus 20 is signaled on whichever time frame the Gartley is that you're looking at, whether it be 1, 5, or 15, if it makes a plus 20 as it's getting within the range of the Gartley, that would be your buy entry. If it's a bearish Gartley, you'd be looking for a red 20, a minus 20 to sell. The 1 and 4 hour charts, oops, there we go. The 1 and 4 hour charts, I would look for imbalances of either plus 5 or minus 5. So for a bullish Gartley, I would look for a bullish Gartley, I would look for a green plus 5 to form in the 1 hour time frame, or a minus 5 to form in the 1 hour time frame, or in the 4 hour time frame also. I would, and this is all dependent on which time frame you see the Gartley forming in. Like a lot of times I'm using this on the 1 hour time frames. You can also get daily Gartleys, Gartleys off like 8 hour charts and daily charts, for which we would just look for the imbalance to turn green or red. If you're looking at like a 24 hour pair view total, which is measuring the last 24 hours in the market, you would just wait for that to either go like green or red. Would be considered a shift in supply and demand. I'll show you what this looks like, because a lot of you are looking at all these numbers and you're saying, what the hell? What are you talking about? Well, let me show you what this looks like on a chart, because this is the way we would look at it on the dollar Canadian 1 hour chart that we're looking at here. Now this is the one I just showed you. We considered this to be a Gartley, even though it didn't hit the harmonics. There's two ways to judge it. Either it's going to be a harmonic Gartley, or it's an impulse move where the A, B, C, and the A and C are equal to one another, which we know this was. We just did this one live, and that's why this is such a great example. Now, before it even hits the 78.6 level, the 78.6 level being our entry trigger if we're just using the charts to enter in on Gartleys. Before it even hits, when you see that you have a potential Gartley form, as I showed you on the previous charts, we would measure the length of the Gartley. In this case, it's 104 pips, right? We would measure from the start to the 78.6 level itself. Because remember, we're measuring the length of this Gartley before it even hits the 78.6 level. We're trying to find a good entry before it even hits the 78.6 level, okay? So the price could be trading like way up here, and this move down in here doesn't even exist yet. So we're measuring from the start. So this is what we call the Gartley projection to here. Now when we look at the length of the Gartley overall, we see that it's 104 pips. So that's the length of the potential retracement, if you will, the potential 78.6% retracement. So what a lot of Gartley traders will do, because oftentimes these things will form perfect Gartleys, and they'll get within like 2 or 3 pips of the 78.6 level, and they will violently bounce off of it and head straight up. So a lot of Gartley traders will look for what we call an entry zone. Now an entry zone, all we do is we take 10% of this number, the length of the Gartley, we take 10% of that, okay, which is 10 pips, correct? And we would add that 10 pips to the 78.6% level. And once it gets within 10 pips of the 78.6% retracement, that's where we'd be looking for what we call an entry zone. Now in this case, if you look at this dramatic fall right down in here, once it gets within that 10 pips of the 78.6% retracement, that's where we start looking for what I call the pair view entry. Now what is the pair view entry? On the 1 hour chart, as this is coming down on dollar Canadian, as this is coming down, pair view is going to be red. It should be showing red, because obviously there's a huge amount of sellers in the market. So it's going to show red. It's going to show a sell imbalance of dollars versus Canadian. It's going to show a large sell imbalance from the market makers. So it's going to be red as it's coming down. What you're going to do, and this is a lot of times what my pair view will look like, here's the dollar Canadian on the 1 hour totals, is as it came down here, okay, since I was looking for my entry on pair view oftentimes will get you better entry. It will get you in with a tighter risk-reward ratio. Either, in this case, it got me in at a lower price because I was watching the market. Instead of putting my entry right at the 78.6, I used pair view to get me into the trade. What that means is, instead of, would you rather buy here or down here? Okay. Once it hit my entry, once it hits the entry range, I'm looking for this number right in here to go up to a positive 5. And you can see here it goes to positive 5.39, correct? So what that's telling you is on the 1 hour totals that you're getting a significant buy imbalance right down in here. Right at this level right in here. It was like 1.08252. So as it hits, again, my entry trigger, I know this doesn't make, for some of you, a lot of this is just going to be feeling it out. Essentially, once it hits this green line, instead of just putting my entry in at 78.6, I'm looking at pair view to tell me when to get in. Once pair view on the 1 hour total, and you see I don't have any of the market makers listed on here, I just have the 1 hour total listed. Once pair view on the 1 hour total goes to +5, that is telling me that demand is now, the buy imbalance is occurring on the dollar Canadian to where we might get a significant reversal. I already know a Gartley has formed, so I'm already looking for a buy opportunity once it hits this line. But right down in here, it gives me a buy opportunity at like 1.0. I forget what the actual price was. I want to say it was like 252 or something along those lines, but it was right down in here. As you can see, pair view, once it created a buy imbalance, gave you a better buy price. Instead of buying here at 1.0838, you bought here, and this is where the eventual reversal occurred. And the risk here is even less, because remember, your risk is putting your stop, your stop's down here below the 100% retracement. Here was our entry. And instead of risking 32 pips on the trade, as we did, if you would have done it off the 78.6 level, in this case, you only risked about 17 pips. So this was your risk if you use the 78.6 level. Using PitView, your risk was only 17 pips. So you get a higher risk reward potential. You can still scale out of the trade. You can look for a 1-to-1 risk reward off 17 pips, and then look for a larger profit as it comes up. But this is which would you rather risk on here? Would you rather be risking 32 pips or 17? This is an example of it giving you a better entry price than the 78.6 level itself by concentrating on the pair view screen and waiting for it to show a buy imbalance occur, which did right here at the bottom. You obviously would rather be risking 17 versus 32, and obviously that gives you even larger risk reward potential. Using the pair view also can keep you out of being, the few times that you will get whipsawed, which, in my experience has been a few times that you get whipsawed in and out of Gartley. If you wait for the pit view to give you confirmation, a lot of times it'll save you from getting whipsawed from when the Gartley gets invalidated and would have stopped you out. It also can get you in earlier. If you use that 10% cushion, as we did here, a lot of times as the price gets near the 78.6 level, the people that use the 78.6 level as the entry oftentimes will be kind of SOL because it'll come down very close, sometimes within a couple of pips of the 78.6, and then move straight back up. The pair view will generally give you an indication of that as long as you use that little 10% method, which is right up in here. Don't worry, we'll do this live, okay? I'm going to show you this live of what this looks like here in just a second. In fact, let's just do it right now. I know we're getting here towards the end of class. So let's do that right now. Let me show you another one here. Now, believe it or not, I'm seeing a bullish Gartley here, even though this was a gapped trade. So this is on the New Zealand US dollar, by the way. If you look here, it gapped down a bit. And if you go to the impulse move from the low to the high, you'll see that, remember, you got to kind of pretend that this is a candle right in here, but this is a gap that occurred, and it already covered the gap, by the way. This is a gap that occurred over the weekend where we had an A, we had a B, and we have the potential for a C coming down here to the 78.6 level. When you connect those together, this is what I mean by eyeballing it. The A didn't come down and perfectly hit the 61.8. You could say it came down to about the 61.8% retracement, but it didn't perfectly come down and hit it. Now, once we see this occur, we can project it out if we want. We can say, okay, well, how much was A? Well, that was 45 pips. B, or I'm sorry, the C projection from the end of B down to here is about 43 pips. So in this case, I would say that even though this didn't harmonically come down to 61.8, I would call this a Gartley pattern. So we'll name this, okay, a bullish Gartley on the New Zealand 1 hour time frame. Now let's go through our entry as far as a PitView entry would go. The projection of the Gartley itself, if we go from this high up here, if we go from this high to the 78.6 level, we see that that's 60.8 pips. So 10%, and we'll just call it of 60, call it 10% of 60 pips is 6 pips. So our entry zone, if you will, our buy entry zone, you see the 78.6 price, 0.82853. That's the actual 78.6 level. But once it hits within 10% of that number, so it'd be 0.82913. Once it hits this level right in here, 0.82913, we're going to look for our entry using the pair view 1 hour totals. Now what was the low in here? The low, this got down to 0.82897. This low right in here got within our entry zone, okay? Our entry zone is right here. And 82913, there we go. That green line is our entry zone, and we see that it came down and entered into that entry zone. So once it gets within this zone right in here, this is where we'd start looking for buys using pair view. So then all we need to do is pull up the pair view indicator. Go up here, I'm going to pull up pair view. And I'm looking at a 1 hour chart. And I'm going to put it in as New Zealand dollar. All I did is I right-clicked here. I right-clicked on New Zealand US dollar, and I have my 1 hour totals up in here. So what I would do at this point is, now that it's hit my entry zone, and you can put this anywhere you want on the screen. Sorry, somebody just asked a question. Well, when you pull this up, okay, a lot of times it's going to show up like New Zealand US dollar on pair view. You know, you can have if you right click on this, you can have a huge amount of columns being disseminated on pair view. I'm trading off a 1 hour chart, so I'm just looking for the 1 hour totals. Okay? So what I do is I right click on the pair view and I go to show and hide columns, and I'm just unchecking anything that I don't need. okay? And a lot of times what I'm going to do is I'm concentrating on what 100% of the market maker activity is. So I won't even show a lot of the market makers sometimes. I'll just have it, I'll just scroll it down to fit my screen, and I believe it's a little bit easier this way, because what I'll do is I'll just scroll the PitView down on New Zealand US dollar, and I'll say, okay, this is coming down now, close to the 78.6 level. What I'm going to do is I'm going to wait for this 1 hour total to go to a +5. Now you see New Zealand US dollar is screaming down. Now what do we like PitView for? Well, we like PitView because it's showing us what the market makers are doing. Right now, this is fitting in with this trend of this immediate downtrend right in here, with the imbalance on the 1 hour chart being -6. So it's still showing strong sell. Now I've told you before, and I'll say it again, really. I've said it before and I'll say it again, that when you're looking at these types of patterns, oftentimes people, all I did there was zoom in, folks, people get extremely, extremely nervous about taking these, because you can see on here, this is a bullish Gartley pattern. I know this is a gap, but this is still a bullish Gartley pattern. This is a strong set of lower highs and lower lows, even though it was a gap, B, and then a C projection. Or, yeah, C projection, which we know this is going to be a valid Gartley if it hits the 78.6 level. Now that it's hit our entry zone now, how many of you would feel comfortable buying it once it hits the 78.6? And remember, Gartleys are not 100%. They're not 100% accurate. Nothing is. You know, Gartleys just tend to give you good entry points to when you're right, you get a naturally higher risk-reward ratio. So in this case, a lot of people, this is where the intestinal fortitude comes from when trading Gartleys, because a lot of people are looking at this level right in here and saying, well, shit, I'd feel very, very uncomfortable buying this right now because it's coming straight down. Like I said, you feel uncomfortable sometimes buying these Gartleys, and, of course, we'd be putting our stop right over in here. PairView makes this easier on us, because now we have something helping us out to where now we can say, okay, I'm looking to trade a reversal here on New Zealand US dollar. Instead of waiting for it to hit, now that it's in my entry zone, I'm going to wait for the market makers to confirm this with me. So I'm going to wait for the market makers to take this thing to a +5 on the totals. They can either do it, it hasn't hit the 78.6 yet, so they can do it before it hits the 78.6, which would, now that it's in the entry zone, would give you a fair amount to get in and actually buy it. Remember, I usually had to wait for it to hit the 78.6 level, but even though it hasn't hit 78.6 level, if this thing goes to +5, I'm buying it. It's gotten within a certain range of it. I know a Gartley is formed. If this goes to +5, I'm buying it. If it comes down here and continues down, as long as it doesn't hit the 100% retracement, now that it's in my entry zone, at any time in here, I'm going to buy it when PairView goes to +5 on the 1 hour totals. And that gives me a lot more confidence in taking this trade. It can get me in early. It can get me in a little bit later at a better price. But the whole confidence builder on this is the fact that when you enter into this that you're going to be on the same side as the market makers, is that you're going to be buying it when the market maker buy and sell imbalance shifts from one direction to the other, which is a beautiful thing, because we all know that if you've been trading with PitView at all, you know that it can sometimes, a lot of times it can act as a leading indicator, meaning as it's coming down, you can see this thing go to a +5, and you'll know exactly that, this thing is about to reverse. So that would be my strategy for today. And this, somebody just asked, is this a trade that I'm actually going to take? Well, yeah. I don't BS around on these things. I only show trades that I think look good that I want to take. So this would be we already know where our stop would be on here. The stop would be at least 1 pip below the 100% retracement, 0.82677. And then the limits on here is the limit 1. Generally, I look for a 1-to-1 risk reward. In order to do this, this is called scaling out. You have to be able to do more than one lot. You have to be able to at least do 2 lots, to like at least 2 micro lots on this. So limit 1-to-1 risk reward on the first lot. Move stop to break even once that gets hit. And then limit 2 would be the 78.6% retracement of the Gartley itself. If you're ever wondering where your second profit point should be, what you can do is you can go from this high to the 786 level. The 786 level is, around that level is considered to be our entry target, if you will. So that gives us our limit 2. When I connect the high to the 786 level itself, so 78.83332, the projection of that. So that would be our second limit. And you can see we don't have to have it come screaming right back up in order for it to give us our entry, or I'm sorry, in order for it to hit our second profit point. It doesn't have to break in any new highs or lows. This is called meat trading. You're just trading really the meat of the movement. So that would be my trading concept or idea for the day. New Zealand dollar having as far as a bullish Gartley pattern. I'm actually very bullish on New Zealand. I know a lot of people may not be because of the fact that it's been screaming down lately. You can see this big downtrend that it's been in as of late. But I'm actually quite bullish on New Zealand because of the high interest rate differential. Even though they might be pausing on interest rates, I'm still bullish on them. But this pair view should give you some comfort in trading this. A lot of people get scared off of trading Gartleys, but I think you can see by using this pair view, it makes it a lot easier, and it gives you a little bit better feeling in the pit of your stomach trading these when you have pair view as a tool. And you don't have to have 5,000 different columns. You can just use the pair view total on the 1 hour, wait for it to go to +5, and that'll get you in. The question is, Steve, if you were trading this just purely technically off the 786 level, would you already be in this trade? And the answer is no. This is what I mean by things sometimes getting within a couple of pips of the 786 and then violently bouncing off. You can see it's coming up now, but the thing is that on these trades, I don't necessarily wait. I wouldn't be in this trade yet. If I was using the 78.6 level as my entry, I wouldn't be in this trade yet. And that's where pair view can help. Pair view can get you into this trade earlier, because a lot of times they'll get within a couple of pips of the 786 and then scream right back up off of it. Pair view can help you get into that just by having the pair view up. So that's why we look for the pair view to go to a +5. You can see it's still coming up, but pair view is still going down. It's showing a sell imbalance still. So this is still giving us a lot of comfort in just watching this. You got to be able to watch it, of course, watching this and just waiting for it to give us a signal. So no, I would not be in this already. It would have to come, if you're trading this purely technically without pair view, you would be buying it when it came down and hit the 786 level. Pair view can just get us in on some of these moves a little bit earlier or at better prices later. Now, I know this is a lot to take in, and I don't expect all of you to understand some of these concepts the first time around. I've always believed in repetition when it comes to education. My classes that I teach on Tuesdays and Thursdays, I repeat a lot of this information over and over and over again, pretty much beat it into my students' heads until they actually get it. One other thing, and this is the last thing, and this won't take too long. I know I'm a little bit over time, but a lot of people ask about time analysis with these Gartleys also. Now, I think using the pair view is an excellent, excellent way. I'm kind of sold on the pair view, using it for a confirmation on this, the way I just showed you. I mean, it's really helped me out in my trading. It's kept me out of bad Gartley trades, and it's gotten me in earlier or at better prices on good Gartley trades, which should be exciting to all of you. Simple time analysis and the Gartley pattern. Time analysis is something that I got a question on from last week that I just wanted to show you what simple time analysis would be. There's a lot of people that measure the timing of these patterns to establish whether it's a valid Gartley or a high probability Gartley, I should say. Simple time analysis, and let me kind of read the question to you that got submitted to me from a student. It said, Steve, is there a certain amount of time that has to be met as far as the length of A and the length and the projection of C? And the answer is there are people that use time analysis when it comes to Gartley. I don't always use it, but you know, it can add to probability. Simple time analysis is measure the length of time. If you're looking at the A projection, you would measure the length of the A projection. That would be your first. That would be your first move if you're doing time analysis. And then what you would do is you would measure the length of time of C to the 78.6% trigger. A lot of people that use time analysis with the Gartley would say that the length of C must be a minimum the time length of A, and cannot be more than double the length of A. A lot of people that use time analysis are purely technical traders that don't want like a news event to trigger a trade for them, so they don't want one sharp bar coming down and triggering an entry. So they need it to be a very progressive technical pattern as it comes down. So these are the two rules, is that the 78.6%, the length of C, the time length of C must be at a minimum the length of A, and that cannot be more than double the length of A. What this would look like on an actual trade itself, like here's a bullish Gartley pattern on a 4-hour chart of the dollar yen. This is one that some of me and my students traded together also. When you look at A, the A from the start of A to the end of A is 42 bars or candles. So 42 4-hour periods, if you will. So that's the A, and here's the B in case you can't see it. I don't know why that ink is red now. So the length of A is 42 bars. So now what we would do is we would look at the length of C. We would measure the length of C from the start of C to the actual 78.6% retracement. So the length of C must be at least 42 bars as it's coming down, and no more than 84 bars or candles. So it must come within these two times. It must be at a minimum of 42 4-hour candles and no more than 84 4-hour candles. Once it does touch and hit at the 78.6 level, the C itself is actually 45 bars or candles from the start to the end of C. So that would be something that most people would say fits into the time analysis also. See, what traders don't want is they think a more valid Gartley is when this, you know, is something that is gradual. Meaning if it takes this long for A to come down, they don't want a sharp news event to come down in one bar and trigger their trade. You know, they would consider that to be fundamentals getting in the way of their trade, you know, because obviously something drastic outside of its range would have to occur. So they would rather have come down gradually within a certain time length, and a lot of people would feel that that gives it higher probability in this case. So is time analysis necessary? It's not necessary. I would not say it's something that I use. I don't use it that often. Somebody asked a question about time analysis of what technicians look for as far as minimum to max amount of time in which it has to form. So they use it to really more account for fundamental shocks to the market. The increased probability of using time analysis can be debatable because everything in trading is freaking subjective. So whenever I get into a room full of traders, and whenever they start debating things, especially technicals, I always just look at everybody and say, okay, everybody's right. How's that? Everybody's right. You're all right and you're all wrong, because everything can be so subjective. I hope you found that to be interesting, us going through Gartley Pattern Part 2. It's a very strong pattern. Again, it can be very hard to get into those types of patterns, but again, it is very strong when it does occur. If you do have any questions, Whoops. I lost some of you. There we go. There's a couple of emails I still have to return from last week, but if you do have any questions, you can feel free to email me at steve.nuri@pitview.com. All of you in this class right now are subscribers to PitView, I believe, but if you need to start a demo account or subscribe to PitView, you can go to www.pitview.com/web, and that'll get you a subscription or a free trial to PitView. As far as PitView goes, and I know a lot of you have emailed me about my classes. PitView I do work with PitView because I do like their, I'm an analyst for them, and I also teach a lot of their education classes. I've gotten emails from some of you as far as my education goes. If you're ever interested in that, I have my own company that I do own called NuriFX. You can email me at education@nurifx.com also, or email me at PitView. It doesn't matter, either one. I have a 6-month program that I offer out to people, which a lot of people have been sending me emails to PitView, but I've given out that email before. But other than that, folks, I'm going to go ahead and I'm going to stop the recording. Thanks for coming in.